Hey there, it's Dave Keller with Market Misbehavior. Today we're going to talk about what it means to have a confluence of support. So I was trying to think about where I first heard that phrase, confluence of support. I want to say it was Connie Brown at some point. I've gotten to know Connie over the years. She actually wrote a chapter for my book years ago, and a great thinker about technical indicators and really growing the toolkit of the technical analyst. In her book, she first introduced me to the idea of looking at ranges and talking with her and talking with people like Andrew Cardwell about how to look at the range of an indicator and draw conclusions from that was transformational. Really changed the way I think about price momentum and about shifts between different phases of the market. When I remember at some point she gave a presentation, talked about a confluence of support or a confluence of resistance. And her point, which is what we'll talk about today, is that when you have different technical indicators with different approaches, different calculations, different methodologies that all sort of coalesce into a very similar conclusion, that has meaning. A lot of times beginning technical analysts, people just getting started, tend to use different indicators that are really the same, right? They're very similar. They use a series of oscillators that if you look at them, there are subtle differences, but they're just subtle, right? So in the end, you're sort of confirming each other, but not really adding a lot of value. If you use very different indicators like moving averages and price oscillators and Fibonacci retracements and volume and different very varied approaches that all sort of combine into a confluence of support, then you really want to pay attention to that. We'll look at a chart of StockCharts here in a minute. You'll see what I mean about a confluence of support. Before we get there, by the way, if you like this sort of thinking about technical analysis, market history, investor psychology, behavioral finance, all of that and more, go ahead and subscribe to my channel. Also, give the video a like if you appreciate it. We'd super appreciate that back. Put a comment below, thumbs up or thumbs down on StockCharts and why. Let me know. So here we're looking at the chart of StockCharts, SBUX, and if you look at the last 2 years, you can see this sort of how the chart is sort of separated into two phases, right? The left half of the chart in a clear downtrend, the right half of the chart in a clear uptrend. And a lot of the videos we do on our Market Misbehavior YouTube channel focuses on those sort of inflection points, right? How can you confirm that the market's in a downtrend? How can you recognize the changing tides, the fact that we're rotating from a downtrend phase back to an uptrend phase? How can we tell that the market's in an accumulation phase where we continue to push higher highs and higher lows? How can we tell that we're consolidating after we've had a rally? I think the technical toolkit is really designed to help you identify what phase different charts are in and make sure you identify those opportunities and those types of charts that really work for you in your process and your investment horizon. So what happened on the right half of the chart is we rotated out of the March 2022 low. We made a pattern of higher highs and higher lows. We broke above the 200-day moving average in the summer into the fall of last year, which I think was pretty meaningful. And then we rotated higher. Year to date, StockCharts has actually been kind of choppy. You can see on a relative basis, it's been pretty much in line with the S&P, but that's after a big rally in April. Made a new high for the year at the end of April, and then we gapped lower. And once we make a new high and then we gap lower, the question is always, what's next, right? Where might we expect support as we go lower? Now, the 50-day moving average is often a first check for me. I always think a pullback to an ascending 50-day moving average is usually a really interesting opportunity, a chance to revisit a leading name that's shown some short-term weakness. You can see we bounced off of there for a couple weeks, but then we broke again back through that 50-day moving average. That's where I immediately start to look left on the chart and look for the lows that stick out. These are your support levels. These are the levels at which previously buyers have come in, right? They've identified short-term weakness. They've bought in on weakness in the stock. So we may anticipate that buyers come in again. So what we can do is actually draw a trend line. We can draw a horizontal line, but I like to just draw a horizontal, just draw it like this, sort of freestyle. And you can see that the low in March lines up really well with the low in May and June. So as we pulled below the 50-day moving average, the question is what's next? I would look to the left on the chart, see that March low that sticks out. That shows you an established level of support where buyers have come in before. Highly likely buyers will come in again, which they did over the last week or two. You can see we've bounced off of that level a number of times. So every time we get down around $97, $98 a share, we're seeing buyers come in and push the price back up. Now, not only does that line up with the March low, you'll also see, if you focus in, this red moving average. That's the 200-day moving average. So after we broke the 50-day, we're now down to the 200-day moving average. That is a commonly used moving average. And having worked with a lot of successful money managers and traders, I will tell you many of them, if not most of them, have the 200-day moving average on the chart. As a matter of fact, even if they're not technically oriented investors, they tend to know where the 200-day moving average is. So I like looking at things that I know a lot of other people running a lot of money are looking at as well. So an expected bounce off of the 200-day moving average and an established level of price support. Now, what else can we tell that sort of builds this case for what we call a confluence of support? Also notice that the RSI became oversold at the end of May. So as we reached the 200-day, as we tested the previous support level around 97, we also became oversold. Now, regardless of the broader market phase, anytime a stock becomes oversold, that means it's gone too low too quickly. And what you want to start to look for is when we rotate higher, when we come out of that oversold region. You can see we just touched that 30 level, touched that oversold level for a couple days, and then bounced back off of there. So that once again confirms the fact that the price was beaten down as it tested support. From there, we rotated higher, of course, and showed some short-term strength. Now, here's where it gets really interesting. All of these, now we've had a couple different techniques, support levels, just traditional support and resistance, looking at the moving average, the 200-day moving average, and looking at a measure of momentum, RSI. Now let's introduce Fibonacci retracements. Now, Fibonacci retracements are a common technique anytime the price has had a big move and then you're retracing between those extremes. So what you want to do is take the low and then take a high, which we'll do here, and then start to see what levels are between those two. So what this does is basically saying if 67, 66, 67 was the beginning of the move in May of 2022, and 115, we'll call it, was the high from the end of April, beginning of May. That was the end of this bullish phase. As we pull back, where might we expect support? And it's these percentages that you can see down here. 38.2% of the way down is right around 96.60. So that's retracing 38.2% of the way down through this entire range. Look at how beautifully that lines up with the March low. So not only did we find price support here, we also find that the Fibonacci level is holding there as well. This is really showing what we call a confluence of support. 4 different techniques: traditional support levels, moving averages, Fibonacci retracements, and price momentum using RSI, all sort of confirming that we're at the right place. So how do we confirm that this confluence of support is working? This is where we have to switch from more of a leading indicator into more of a lagging indicator, right? How do we measure that the support has held? Number one, we have to hold this price level, this support level, or this price level. So as long as we remain above, we'll call it $96, that would mean we're holding above the March low, we're holding above this Fibonacci level. As long as we hold above that price level, that tells you that the support so far is working as expected. Every time we test support and buyers come back in, the price moves back higher. If that stops happening, that will tell you the confluence of support is no longer working. We may want to manage our risk and make sure we have our stops updated now, just in case that would happen. Another thing to do would actually be looking at more of a lagging indicator. Something like MACD is something I like to use in this situation. So I'm going to change the bottom indicator to the MACD indicator. You can see just in the last day or two, we've gotten a buy signal. So what that means, a buy signal from the MACD is when it goes below 0. Last time we saw that was back here in March. We can see the downtrend in price, the downtrend in the indicator, it gets well below 0. Then we have a buy signal where the MACD line crosses up through the red signal line. That tells you that this short-term downtrend is most likely over, and that we're starting to not just approach a support level, but we're confirming support by the fact that the price is moving back higher. So that's your buy signal here. We actually just got another one of those this week. So what that's telling you is we have indeed found support here, and we're breaking above that level. So why is a confluence of support interesting? Well, a lot of times people tend to look for a holy grail, right? One indicator like MACD or RSI or moving averages, and all you need is this one indicator, and then you're done. Just follow those signals, and that's all you need. Seasoned technical analysts will tell you that is a mirage. That holy grail concept does not play out in practice. It's rare to find one indicator, if not impossible, that tends to work all the time. A lot of indicators work a lot of the time, and by combining them in meaningful ways, we can increase our probability of an effective buy or sell signal. What we're looking at with the example of Starbucks is where we've had a confluence of support, a series of different indicators, very different calculations, very different types of indicators, all coming together to indicate a potential bottom in a stock like Starbucks. As always, you want to make sure you manage your risk effectively, make sure you have an effective stop in place just in case a signal like this doesn't work. But I have found in general, high probability trades start with high probability combinations of important technical indicators. I'm Dave Keller with Market Misbehavior. Back to you again soon. Bye now.